Thank you, Jason. Amos?
I think between what I said before and what Jason just did a very comprehensive job of covering it. I'll just comment a little bit about the presentation that we saw. Mark Twain was never kind to the concept of statistics, and I think that sometimes it's how you present it. And if you look at some of the peaks and valleys of the oil prices over the last decades, I could look at that chart, especially the one that Professor Yashiv talked about, which showed north of $130 and then a rapid decline. When you see sharp rises and sharp declines, normally, like the ones that you showed in the charts, they tend to be in response to an extraordinary event. And despite the fact that in the oil business we always talk about, no, we make decisions based on 25, 30 years. We're not victim to momentary, to any news of the moment. That's not how prices work. And it's not actually even true about how oil companies work. But 130 was because the Libyan conflict began, and 1.6 million barrels a day went off the market almost overnight. And the market had a sharp reaction to the fact that until then it was a very big difference between an Arab Spring in Tunisia versus for the oil markets in a place like Libya that just came back from sanctions within a couple of years, and there you lost 1.6 million barrels a day overnight, and how will that be accommodated for? And you had this massive spike, and if you recall, it created a extraordinary moment for the United States and for the IEA, where we actually intervened in the market through a release, which Jason is familiar from his previous job. But then you had a massive decline in price because another extraordinary thing happened. The expectation was after Gaddafi was killed and the new government took hold, that it would take years to bring back the production. And instead, it went actually pretty quickly. And you started seeing a decline in price because, first of all, the stability of the conflict was over, or at that point in time it was over. And then you had that decline again because the production came back and because markets seem to calm down sometimes after they see headlines. And everybody calms, and then we start assessing how did this actually impact the supply and demand. So just to say that as we look at predictions, we should also look at not only the history, but we should look at what the predictions were at those points in time. And remember that predictions are very important as we look to how to act in the future, but we can't rely on them because it's so difficult in the oil markets with the kind of volatility and the increased geopolitical constraints that have come into the oil markets. Let me touch on one thing that Jason talked about and about the U.S. shale. As we see, and I like what he said about it's always $10 below the actual price. I didn't think of it that way, but it's entirely accurate. If we look at shale, even if you have less investment in shale, or you hear about lower capex into the shale investments, it doesn't mean that that is a one-to-one ratio of less production, because what's happening in the United States is a constant degree of innovation. So the cost of shale, everybody keeps saying, what's the break, everywhere I go now, what's the break-even cost of shale? And there's no answer to that, because every project is different, and the level of innovation is such that the price of the cost is going down as well. And where it is today will be different than where it is tomorrow. So because of that, even though the investment, the capex investment will be lower, you could end up seeing a growth in actual production because of the efficiency in the system. So everywhere we're seeing constantly better efficiency rates, and in shale, the rate of increase of efficiency is growing much faster. So I think you can see that it will be producing more with less. The resilience that Jason also talked about to the price, I think, is obviously to a point, right? I mean, there's going to be some point where we're going to have to see some kind of recalculation. But I also think there's a difference between different companies. Now, it's what the position of how much debt do companies have? Do we see a consolidation in the market? Those are different things that we're going to have to see some of the smaller and independents who are operating in the shale and how that price affects them. The winners and losers that everybody is discussing is also kind of complicated because we have different countries are going to be affected by the price dislocation in different ways. And I think that's going to be the fascinating thing to watch. And as a reminder, we are only 3 months into this new world. The same guys and the same banks who are writing in June and July that 100 is the new floor. And don't expect a sub-100 price anytime soon.
It was 98.
And at the same time, the same people who wrote those notes in those banks are the ones, if you look at the notes that they've written in November and December, just a few weeks ago, one of them who I had read in the summer said, 80 should not be seen as the new floor, 60 should not be seen as the new floor, this can go all the way down. So covering themselves on the other side. So predictions are important, but the headlines of the day, and there's a gap between the coverage of oil prices and the understanding of what's actually happening. And the difference between that Jason described, how easy it is to ramp down and ramp up in shale, which is exactly the opposite of offshore conventional production, where it's a very difficult process. It takes 30 to 90 days to increase. It could take equal amount of time to decrease. It has costs associated with it. So we're still in the days where people think, well, will they cut? Will they not cut? What will a cut look like? Versus a flexibility that the companies in the United States have on the onshore unconventional in both oil and gas. They have that flexibility to be able to address. When oil price drop was a hypothetical, in other words, when we were thinking of 100 as a floor, one of the things that people discussed was what would happen if we'd see oil price declines. And one of the conventional wisdom was that, well, we could actually see an increase of natural gas prices as a result of oil because of the associated gas and all kinds of other, and with the increase of associated gas coming out of the shale oil boom and so on. But in fact, the opposite happened. When oil prices went down over the last 3 months, and you look at the graphs, gas prices actually went down as well, and quite dramatically. So in the United States, there was some expectation that the closer we get to exports, Henry Hub or U.S. benchmark pricing for gas will rise. Some said 5, some said 6. We went up at the beginning of the winter, as we normally go up in the winter. We went up to about 430, 440, I think, at one point. 450. We're now at 360. So with decline of oil prices, actually gas has actually gone down, even in the United States, where the thought was it would increase. If you look at the prices of spot prices for LNG in Asia, that went from a high of $20 in Japan after Fukushima and stabilized at $18 or so, and now this summer at $10. Europe looking at sub-$10. I'll give you one example of that, and then I'll end there. As part of the gas deal with Russia, between Ukraine and Russia, the deal was they shut off the gas on June 16th. In October, we reached a deal, and prices are set quarterly linked to Brent, just to see the impact. The price was supposed to be $385, but by the time we reached the agreement, due to linkage to Brent, we were at $378 for the quarter. January 1, that price is going to go below $340. So it's a remarkable transformation as far as thinking about what the cost of every BCM means for Russia as the gas prices. And I guess I lied. I'll do one more sentence. The WTI spread that you talked about, I think here is a plug for our own U.S. officials who, what I'm trying to do is change the way we discuss this. The United States will never be energy independent, ever. Even if everything we consume comes from beneath our feet and our oceans, we will not be independent. And I think the best proof to that is if you look at the graph, the very helpful graph that Professor Yashiv talked about showed of WTI and Brent. Brent rose in those crises points. WTI rose with Brent and declined with Brent. And yes, the spreads got a little bit bigger and a little bit narrow, but by and large, we rose and declined together, even though our production has changed so dramatically. Meaning that a disruption anywhere in the world will have impacts everywhere in the world, including in the United States. It is a global commodity, and we're not immune to it. We can become more self-sufficient, which we are. We can become more hemispherically sufficient or reliant, as we are. But we will always be part of a swing of different kinds of oils in the United States.
And even for that brief period when the U.S. oil price was $25 below the world price, the price at the gasoline pump was being set by the world price, not the U.S. price. So it was a good time for refiners, but not for anyone else.
Amos, two things. One, what was wrong with Jason's joke, or what Rubini and Thomas Friedman hinted at a strong political message to both Russia and Iran, done through allowing the price to go to where it is. Number one. Number two, your Libyan explanation to this V in the prices in 2011, 2012, in my view, the 1.6 million barrels a day was, 1.6%? About of the daily,
even less.
Huh?
Even
less. How does it explain the whole decline of the price? So, two very quick questions.
So the problem with assumption of secret deals between the United States and Saudi Arabia on collusion on price controls and controlling the world is inherent in the question, I think, that just not how things work, and secret deals. Also, I always love to say when it's published as a secret deal has been reached. It's like, well, it's clearly not that secret. It's just not. Countries operate based on interests. Part of the problem around the world is that people don't understand how different the United States is of the rest of the world. We are one of the only countries in the world that do not have where we are not the energy company. Now, most energy companies around the world are either government-owned or government-controlled in one way or another, whether they're 100% owned or 25% owned. But look around the world. That is, we've been having the independents versus the nationals oil companies sort of change, but it's still the United States is one of the only places where I have so many companies. The President of the United States, if they called Rex Tillerson of Exxon and said, here's what you need to do, I can guarantee you he'll do the opposite just to send the message that you can't tell me what to do. So it really doesn't work that way. And as far as asking, we coordinate and we inform each other and we discuss energy markets and so on, but Saudi Arabia makes its own decisions, the United States makes our own decisions, as do all other countries in OPEC. It's just not, yes, we do, when we have crisis points, we tend to talk more about how do we address the crisis so it doesn't drag the world into a recession or a depression in different places. That's true. The reason that Jason was making the joke is because it's the first time that we're aware of somebody was alluding that on the decline side, that we want to stop oil prices from going down. The American electorate is usually told by its politicians that that's a good thing. So if you had a headline, the U.S. government was trying to raise prices of oil and gasoline, that would not go over very well. I still remember being on the Hill summoning in 1999, summoning the Secretary of Energy to our committee, to the Foreign Affairs Committee, to tell him that gasoline prices may reach $2, and if that happens, it's the end of the republic, and that we're going to have to do something about it. So there's a very sensitive point there. On the Libya issue, look, it's not about the 1.6. It's about the fact that we were in a point in history where the Arab Spring was going from country to country, and for the first time reaching a oil-producing country. And 1.6 million barrels went off the market overnight. And it wasn't just about those barrels. It was, what does this mean about the future? Where are we going? What's happening? And I think as things stabilized, that changed as well. The analogous to that was when ISIL took over Mosul. Prices shot up from 108 to 116, almost overnight. When did they decline? It wasn't because of Mosul. There's no oil fields in Mosul that are producing all that much. And the fields that ISIL already had before from Syria. The concern was this can spread down. What happens if this goes south of Baghdad all the way down to Basra? And if it goes to Basra, what happens if it goes just across, about a few meters away into Kuwait and so on? So that's where analysts look at it as once the air campaign began, it became the assumption made by the markets was that was no longer a threat, and prices started to come down. So again, it's not necessarily about the Libya itself, but that was the marker for what else could happen.